Constructs, right? So let's walk through it for a pre-construct. So of course, for a pre-construct, there's going to be no unit, so no rental income. Of course, it's still being built, right? In terms of expenses, you're going to have no expenses because it's still being built, right? Investment wise, you're going to end up putting down 20% over a duration of time. It could be a year, could be 3 years, could be 5 years, whatever it is. So now, of course, like you're not going to have any mortgage until it closes. So there's not going to be any expenses in terms of like paying a mortgage or any additional fees or anything like that, right? Your income $0 because there's nobody living there because it's still getting built. So in terms of your total income, your monthly mortgage costs, all that, every year cash flow is gonna be zero. Still getting built. All right, so cash flow zero, right? Principal, you're not getting the mortgage pay down, so that's gonna be zero. Now appreciation. So interesting enough, I was talking to a co-associate, and something was pointed out since I think it's since 2017, pre-constructions have started pricing pre-cons in anticipation of what they will be worth in the future. So there was a time where you can purchase a pre-con and you'd be able to get a lot lower than the value. Now builders are starting to price it in anticipation to what it will be worth when it builds up, right? So we're still going to use that 7% appreciation number because that's pretty much standard with what we're seeing with the resale properties over duration of time. The beauty is you have something new, right? So you're looking at a 35% return on investment. So the beauty of this is you have no expenses, you have no mortgage, you have no liabilities. You're paying your 120,000 and you're getting a 35% appreciation value of you're getting a 35% increase on appreciation in terms of your return. As well as so your total ROI will essentially be banked on the appreciation, which is 35%. So $42,000. So you're getting that 35% appreciation year over year, same as you would if you have a resale, except you don't have to worry about all the liabilities. Now remember, when the property closes, if you're going to use it as an investment, then you're going to be basically circling back to where we started. If you're buying a condo, this is where you'd be at. If you're buying a single family home, this is where you'd be at. Go back to our first two videos to see what's going on. I would just say that the only difference is closing costs. If you can see here, I actually put a little bit higher because closing costs are normally a little bit more on pre-constructions. So that's going to impact your return on investment a bit just based on the closing costs being a little bit more. So that is something to be mindful of. So this is what the outlook would look like for you in terms of a pre-construct scenario.